Good day, fellow investors. One of the common questions that I get, yes, Sven, this is all nice if you are young, but how should we that are older than 50 invest? What would you do if you are 60? And I never made a video about that because I couldn't understand the concept. So I thought a little bit about the questions that come commonly, and in this video I want to discuss how to invest if you are more than 50, 60, for those that are there, and also give a concept of what investing is for all those younger ones that are investing for retirement. There are always worries retiring, so you think you have a time limit to what's going on, which then might mess up with what you're doing, and it all depends on what you own. So also that is a lesson for the younger one to really be careful about how you invest and what you own when you are going into retirement, and buy assets and things that are there and will be providing value no matter what over the long term. And also Chris Down said that all works well. A crash is good for youngers but not good for older investors, and I must say I disagree. Let's start with the discussion. And this is key when it comes to investing, no matter the age. It's about your investing principles and investing concepts that you have. I am a value investor. What does that mean? It means that I look at low risk, high reward investments, and that is the first basics of whatever I do. And when you look at low risk, good reward investments, the key is the low risk. Then the age doesn't matter, because if you can find those investments with a margin of safety that will probably deliver, it takes between 3 and 5 years to deliver on that margin of safety, but you have a bottom, you have a low risk, and that's value investing. And that's the first premise of wherever I am, whatever age I am, I look at margin of safety, look at low risk for a good reward. Buying below intrinsic value, something of long-term value, fundamental value. And when you approach investing in that way, then it doesn't matter what age you are. Of course, if you are invested in the S&P 500 and your pension depends on the S&P 500, it's normal that you feel shitless scared, because that's how things are, and you didn't think in the past or what is the right style of investment. You just got lucky here because the Fed bailed you out, but that's luck. If you would have been here for 10 years and here had to retire, then it would be a completely different story with the 0% interest rates. So it's very delicate, but therefore I again reiterate myself, value investing works no matter when and where, and works over the long term, which is, it will be dead, it's always dead, and I hope it stays dead forever in the media, because that gives us the advantage to find those value investments that work no matter what, over time, constantly, and create long-term wealth. A funny discussion on age and investing. Buffett was 60 here. Let's imagine that he said, okay, I'm 60, I need to retire, I need to put everything in, I don't know, the S&P 500 or bonds or whatever. 7,000 over the next 30 years, we are now at 350,000. That's 50 times his money. Concept of investing. If he had a different idea here, he would have made 4 times his money, but I think 50 times is better. And therefore, again, I'm reiterating myself, it's about the concept of investing and what concept you have. And then Sven, you say, yes, something can happen in the market, stocks go up and down, we don't know what will happen. And that's something, again, very important that brings to basic investing fundamentals. The key for retirement, I think, is to have everything settled for the next 3-4 years and to be flexible. You should get your social security, your pension, you should be settled after a certain age by the government. So you have to be anti-fragile, not fragile. So in case something happens, there is really a bad market or something, you can lower your expenses and wait it out 1 year, 2 years, 3 years. So that's also something. Don't expect everything from the market. I've got so many emails. I have 600,000 in my pension fund and all S&P 500. If it crashes to 300,000, I cannot deduct from my pension. And that's, again, investing concept. Are you investing in businesses that give dividends, that give yields, or you're investing in financial engineering pension system? That's, again, a concept that, of course, many are scared, but it's very important to understand. Don't bet your pension on the financial engineering. Bet it on value. That's the best way. Actually, what Buffett bought when he was 60 was this. And look at the chart. So he put $1 billion in 1988 into Coca-Cola, and he has increased his money 20 times or even more, and he is now getting a dividend yield of 3%, but on 20 billion, so he's getting a 60% dividend yield on his Coca-Cola that he invested when he was 60. So I rest my case that it doesn't matter what age you are, it matters what you are buying. So wherever you buy, what you buy, it's about quality first and why you are investing in that asset. This was for long-term growth in dividends, and it sure paid a lot to Buffett. And if we put this into a life cycle, so okay, you accumulate over time, but if you accumulate well, you buy a house, you buy a rental property, you start a business, you do some side hustles, you do this, you do that, you think, you invest in good stocks, compound over time. In this phase, you should do really, really well. 40 years are a lot, so that here you can just live off dividends, rental income, with low interest rates, with this, with that. Oh, don't tell me I want to give something to my children because they have it hard. That's also a story that people tell me. They have it hard. They have their whole world at the fingertips now with zero interest rates. And 30 years ago, when you were buying your house, you had to pay 10, 15% interest rate on your mortgage. And your kids have it difficult. Use the money, bring your wife to Paris or something. It's insane. Don't give kids anything. And that's the key, again, a fundamental key. If your kids know in their subconscious, oh, we will get, they become lazy, they stop thinking, it inhibits their potential. Don't give them anything, give them an education as much as they will if they want that, and then give them a kick in the butt. It's life, welcome to life, fight for it. If you give them everything, they will lose it because they got it for nothing. Think about that key retirement concept and enjoy Paris. If you have acquired here a portfolio of stocks, of index funds, yes, you did really well over the last years, but now you are scared. What if this happens? 50% down, 50% down. Here we can also see 50% down if it just goes where it was 5 years ago. So valuations are scary, and it is again on the fundamentals. I hope you have a rental property. I'm working on that. My business, we are trying to build a school or something like that and then rent it for 50 years. So I'll have stocks, business, rental properties, etc., and building in the accumulation phase so that when I'm 60, I am well over rich so that I can do whatever I want. And that's also the message to all the younger people here. All of you that are below 80 watching this, we are going to do great over the next 10-20 years. Then just discussing the 4% rule, where at a certain age you sell 4% of your portfolio. It's too rigid for me. It doesn't think. Everything that's mechanic, I hate it because it's not common sense. It's just, okay, this is the easiest thing to sell to stupid people that don't understand anything about finance. 4% rule, okay, the market doubled. Yes, I can take 8% and go to Paris. The market crashes. No, won't take anything. I'll wait because I know that there is value in what I own. But then again, it brings me to the next concept of investing, which is knowing what you're doing. You go to school 20 years, you work 40 years, and then you retire, and you work for money, for life, for retirement, but you spent, I don't know, 60 years of your life learning, working for somebody else, and you didn't spend enough time to learn how to build your wealth over time, that's a tragedy. So another concept, learn what is investing. Even if you are 60, you will learn in a few years. You still have a long way to go, but you will be in peace, not worrying about money. My plan, my conclusion, when I'll be 70, 80, 90, I'll still hopefully work, write books, but I'll look every month at the dividends coming in, the rental incomes, etc., and then see what to do with my money, probably donate it all over time, and also have enough to live a good life, a great retirement, travel, and enjoy as much as we can, now and also tomorrow. Carpe diem, quod minimi credula posteri. Also, quod minimi credula, put as little faith in the tomorrow with Carpe Diem, or put as little faith in the government for your pension, because there are big imbalances, as we already mentioned in the video a few days ago about pension dangers. I'll put a link in the description below. And because there are imbalances, and nominally you might get your pension, but realistically it will be much lower value than what you are expecting. And I'm constantly getting these emails from my Dutch pension fund. We are going to lower the pension, we are yes, no, and they will be forced because interest rates are zero, so the pension funds are not making any money. If the stock market crashes, it will be really, really bad, and all the governments are extremely high in debt to pay the current pensions, to pay all the benefits, especially in the United States. So it's going to be ugly. Therefore, you have to think about the fundamentals of your life. Thanks for watching. Let me know in the comments what you think about this, and I'll see you in the next video.